Good morning. My name is Rob Misey, and welcome to another episode of my continuing series on the international tax provisions of the 2017 Act. Today we're going to talk about planning to maintain the transition tax deferral while reducing global intangible low tax income, known as GILTI. So, remember the transition tax? It was only a year ago when we were struggling with this one-time tax. I've always hated the word transition. It's kind of like when my 6th grade math teacher said they're going to transition to me another class, and I found out I was in a class with 4th graders. Not too fond of transitions. But if you remember a year ago, we had this potential for big tax hits to the extent you had accumulated earnings and profits and cash or cash equivalents. So what did we do? They came up with this weird indefinite deferral in 965A for S corporations that own CFCs. So we contributed a lot of CFCs to S corporations so we could indefinitely defer payment of the transition tax, although the actual income constituted previously taxed income. Now we're worried about GILTI, and we're not talking about my buddies from high school. GILTI is the income of a CFC that is greater than 10% of depreciable assets. So let's show a quick example. It applies to all kinds of U.S. shareholders. The problem is that only C corporate shareholders get a foreign tax credit. So here we have U.S. individual owning an S corp that owns a CFC, 10 million in depreciable assets and 2 million of income. What 10% of the 10 million? 1 million. So the excess 2 million over 1 million of 1 million is GILTI. And the tax on that is going to be $370 grand. That's a big hit. So the classic planning tip was contribute the CFC to a C corporation, because a C corporation received a 50% GILTI deduction and even gets a limited deemed paid foreign tax credit. In sum, to the extent that the CFC pays tax at an effective rate greater than 13.125%, the C corporation won't have any GILTI hit. But this created a tax planning conundrum, because before the contributions we had to have PTI, and any dividends were tax-free because of PTI. But now, we're going to have tax from GILTI unless we contribute such that we don't have GILTI, but the upstream dividends are going to be taxed at 23.8%. So you either contribute or not contribute. It seems like we're stuck with the lesser of two evils. But here's an idea. How about if we have the CFC distribute a note upstream before contributing the CFC to a C corporation? Now, the note does not trigger the end of S corporation deferral due to the 965 election, and it's not going to be taxed to U.S. individual on the upstream distribution because of the previously taxed income. When we contribute the CFC to the C corporation, we won't have any tax on the GILTI as long as the CFC pays tax at an effective rate of 13.125%. As the note payments are made on the note, it's not going to be taxed. It's merely a payment of a note. Of course, the note must follow the legal formalities, including an arm's length rate of interest. Well, thank you for joining me to discuss this tax planning technique due to the 2017 Act. I hope you'll think about joining me next time.